An asset's liquidity represents the ease with which that asset can be converted from an investment to cash. Liquid assets are those which are easy to convert to cash quickly and experience little to no change in asset value when converted. Illiquid assets are harder to convert and may have a substantial reduction in value once converted. Cash is the most liquid asset there is, whereas real estate is an example of an illiquid asset because not only can it be difficult to quickly sell a home or other property, there may also be a significant difference between the paper value of the property and the amount it can be sold for. When making an investment, investors will often weigh the anticipated liquidity of an asset along with its potential for gains before making the investment. Liquidity is important to investors for many reasons, including liquid assets give them accessible means to reinvest in other assets when prices are low. Liquid assets reduce some investing risks by ensuring that an investor will be able to quickly react to market moves and lock in and realize investment gains. Liquidity is also important to investors as a means to support their lifestyle needs. A retired individual might like liquid assets because he or she needs to be able to draw an income from their investment portfolio now, not later. A young family with children might like liquid assets because they provide them the freedom to convert assets into cash as needed.
Financial instrument is a general term used to describe a monetary asset. Depending on the type of financial instrument, the owner is entitled to either part ownership in an entity, usually a corporation, or payment of interest and return of a principal amount equal to the face value of the financial instrument. Financial instruments that give the owner an equity interest in a business are usually referred to as stock. Financial instruments that entitle the owner to interest and principal payments are usually called bonds. Technically, savings accounts, loans, and even accounts receivables are considered financial instruments, although they are not as liquid as stocks and bonds because both parties have to agree to their sale or transfer. Derivatives are another type of financial instrument. A derivative's value is based on the market value of an underlying asset because ultimately a derivative is a right, usually an option, to buy or sell the underlying asset up to the time the option expires. Financial instruments are the cornerstone of a capitalistic economy. The ability of investors to trade financial instruments through financial markets provides efficient transfer of capital to its most profitable uses.
Both gross domestic product and gross national product try to measure the market value of all goods and services an economy produces. The difference between the terms is how they define the economy. GDP refers to the domestic levels of production, while GNP measures the production of any person or corporation of a country. For example, the American GNP includes the production level of any American or American-owned entity, regardless of where their production takes place. GNP can be higher or lower than GDP depending on a country's ratio of domestic to foreign manufacturers. China's GDP is 300 billion greater than its GNP due to the large number of foreign companies operating within its borders. The United States' GNP is $250 billion greater than its GDP because of the amount of American production that occurs beyond the country's borders. GDP is referred to more, but GNP is a better measure of national output. Using both terms is important when describing a country's economic worth.
A cash flow statement records the amounts of cash and cash equivalents entering and leaving a company. Cash flow statements are used for budgeting because they reveal a company's financial health and efficiency and predict future cash flow. The main components of cash flow come from 4 areas: operating activities, investing activities, financing activities, and non-cash activities. Operating activities reflect how much cash comes from a company's products or services. Changes in cash, accounts receivable, depreciation, inventory, and accounts payable are related to the operating component. The investing component refers to changes in equipment, assets, or investments. When you buy things like new equipment, investing is considered cash out. The financing component is made up of changes in debt, loans, or dividends. Financing is cash in when capital is raised, and cash out when dividends are paid. Non-cash items are calculated into the net income as well as assets and liabilities. Transactions not involving cash items often have to be reevaluated when calculating cash flow from operations. Remember, all four components can be recorded on the cash flow statement as cash in or cash out. One of the ways to calculate cash flow is to add up all of the cash payments and receipts, including cash paid to suppliers, cash receipts from customers, and cash paid out in salaries.
We're going to start off easy with things that most of us are pretty familiar with. So we're going to start with the idea of what is a security. Most of us are familiar with the term, but the technical definition of a security is that it's paper traded for value where a profit's anticipated through third-party management. Now, the two basic types that most of us know are going to be stock and bonds. Equity or stock is going to give a customer ownership in the security, whereas bonds or debt securities are going to give the customer loanership positions. We have other types of securities as well besides stocks and bonds. We also have mutual funds, variable annuities, which are considered to be securities, options, which are securities in their own right and derive their value from the underlying security, and we also have rights and we have warrants. Now, it's really important for the test to determine what's a security and what's not. So things that are not considered securities, if you see whole life insurance policies, those are not securities. If you see term life insurance policies, those are not securities. Fixed annuities are not securities. Now remember, variable annuities are, so you want to be able to make that distinction for the exam. IRAs and retirement plans in and of themselves are also not securities. They're actually shoe boxes, if you will, and you put your securities into the shoe boxes, which would be an IRA or some other type of retirement plan. A prospectus is not a security because a prospectus is nothing more than a disclosure document. And a confirmation is not a security because your confirmation actually confirms that whatever trade you wanted executed was in fact executed properly. So again, for the exam, one of the questions you can see is what's a security and what's not a security. When a corporation decides that they're going to incorporate, the first thing that they do is they go out and they hire themselves a lawyer. Now that lawyer is going to draw up their corporate charter. And in that corporate charter, they're going to address the idea of common stock. Now, that common stock that they address will be in the form of authorized common shares. So the easiest way to think of it is that authorized common stock is stock that has been authorized for sale in the corporate charter. Now, the registrar is an entity that's put in place or hired by the issuer to make sure that the corporation does not issue more shares than they've authorized in their corporate charter. Now remember, just because a company has authorized a certain number of shares doesn't mean that they have those shares actually in the public hands or that they've even issued those shares to the public. Authorized is simply what's on paper in the corporate charter. Issued stock is stock that's been actually issued to the public. So if the corporation decides that they're going to issue a certain number of shares, those shares will be in the public hands.
Now that we know what calls and puts are, let's talk about, are there certain characteristics you need to know about when you're buying options? There actually is. The first thing when you buy an option is time works against you, right? So if I write you a policy, I'm an insurance company, and you say, hey, I want you to insure my house for the next 3 months, I'm going to quote you a price. But if you come back to me and say, quote it for a year, well, that time value is going to be inflated. So I want you to think about that as whenever you're buying options, time is working against you, and you have to make above that time value for the trade to be profitable at expiration. We'll come back to this in a second, but let's talk about some other characteristics that we want to know when we're buying options. One of the best things to talk about when buying options is that the premium that you spend is the max that you can lose. So if you spend $200 on buying an option, that's the most that you can lose. You can sleep easy at night knowing that your floor is set. That's also why it's very popular to buy options. People like to know what their risks are from the onset. When you buy an option, your risk is limited to the premium spent. When buying options, gains are unlimited for calls and limited to a zero stock price for buying puts. Also, you have the right to buy or sell stock if the option expires in the money. So let's talk about calls for a second. When you buy calls, what are you doing? Well, it's the right to buy stock. Now, if you have the right to buy stock, why did they say that the gains are potentially unlimited? Well, imagine you buy a call on a biotech stock and some positive news comes out and the stock goes from, say, $20 per share to $100 or $200. The point is gains are unlimited because the stock could theoretically go up to infinity. Let's talk about puts for a second. Buying puts is giving you the right to sell your stock. The important thing here is that your gains aren't unlimited, but they are limited between the strike and zero. What does that mean? When you buy puts, you have the right to sell stock. So the most you could potentially make is wherever you're going to sell that stock and a zero stock price. A stock can't fall below zero. So it's important to know that when you buy puts, the max that you can make is the difference between the strike and zero, minus the premium that you spend. And lastly, you have the right to buy or sell stock if your option expires in the money. So if you're buying a call, you have the right to buy stock. If you're buying a put that expires in the money, you have the right to sell stock. I referenced time earlier in saying that that's an important component to know and to consider when you buy an option. So let's look at this grid right here. We know that time works against us by looking at the slope of the options price as time passes. So down here, this is 100 days till expiration, and that's 0 days to expiration. So the further out that we go, further away from zero, the more value, the more time value that the option has. So if you're buying options, just keep in mind that the option is decaying each day that passes. So whenever you hear often that options always expire out of the money, are worthless, there is some truth to that. And the reason is because you're buying a decaying asset. Time value always settles at zero. So it's important to know that whenever I was trading at investment banks or in a sales capacity, we love to sell options. The reason we love to sell options is because time worked in our favor. Remember, we kind of started out positive on the trade from the get-go. So when you're buying options, remember you have to overcome all of that time value that's constantly decaying against you.